to double the size of our store. Well, to be able to buy the capital assets, you got to bring in enough cash to make the loan payment for the capital asset. The capital asset has to make money. So usually in a case like this, we will look at what's the depreciation rate, how much money do you need to get the capital asset, and what will you be writing off for that capital asset. And that's a lot of times where the bank steps in and says you need to analyze your cash flow. To make sure you can meet your debt obligations. So this is what we're hitting right now with the farmers. A lot of them have input loans due by a certain date. Or they've got a Canadian canola growers advance due by a certain date. They've got a $40,000 land payment due on the 15th of June. They got to make sure they've got enough grain sold by the 15th of June to be able to meet that debt obligation. So this tells them when you need to bring in some income, or you need to get into the bank, have a good relationship with your banker, and get some bridge financing to meet that obligation, or a quick loan or something along those lines. To be able to make sure your cash flow is low, oh, I think there's a typo there.
Oh no, to be able to see where the problem is.
Oh yeah, to be able to see where your cash flow is low and make decisions to improve it. So this kind of goes back to the same thing as before. Is it inventory that's not turning over good? You should be able to see that when you analyze your cash flow. Is it that you're not invoicing quick enough? Is it that you have crappy customers that don't pay their bills? Because if they don't pay their bill, they're not the customer you want. So anything like that, your analysis of it should basically tell you a story. I often say that people always want to know what their net income is, but if you actually learn how to read your financial statements and learn the story that those financial statements are actually telling you, you'll get information out of those statements to help you manage your business beyond knowing what your net income is. There's a lot of other factors involved. And we're actually finding that a lot of people that are in business do not know how to read their financial information once they get it. Some aren't interested in learning how to read it. They say, I'm going to forget all this as soon as I walk out of your office. And that's exactly what they do. But if you do want to use your financial statements as a management tool, get your accountant to teach you how to study your financial statements and read the story that's in there, because it tells a short story. Okay? The next one is to assist in valuing a company. The better the cash flow, the better the value. So this is where one of our valuators would come into play. They would look at your cash flow and use that as one of the tools to putting a value on your business. Okay? So if you're not generating enough cash flow, your business doesn't have a whole lot of value. So, what can cause cash flow to be poor? Paying cash for capital assets instead of financing those capital assets. People hate going to the bank and begging for money. They absolutely hate it, because you're putting your life into somebody else's hands. You're giving them control. However, if you start buying capital assets and you're not financing them, you could be putting out an awful lot of cash compared to the amount of deduction that you're getting. Like for example, an air seeder is a 20% depreciation rate. You only get to claim half the first year, so you could spend $100,000 cash on an air seeder and only get a $5,000 expense for it. Where did your cash flow go? It's gone. You invested in an air seeder that you're going to be writing off for the next 5 or 6 years. Where if you would have gone to the bank, got the loan from them, spread that loan out over 5 or 6 years, you would actually be paying out pretty close to what you're getting for an allowable deduction. So it's good to know when you're buying capital assets, first of all, what your depreciation rate is on that capital asset. So usually vehicles, self-propelled equipment, things that have an engine of their own, they are usually a 30% rate. Pull type equipment and shop equipment like cash registers or welding equipment, things like that, they are usually a 20% depreciation rate, and buildings are usually 10. So with farmers, for example, we really encourage them to finance their building purchases, or I think I actually make this point later on, lease. Even if it's a used building or if it's a shop that you're getting built, you can get a lease set up on that.
The problem
Property.
is that, I mean, it's one thing if you're an established business, but Courtney and I have been in business for 3 months. No one's giving us a loan. Right? I mean,
It's very
like
difficult.
personal loan, yes.
Yeah.
But the business can't even apply. We're not
Yeah.
even allowed to apply for 3 years for a business loan. So, I mean, it's great to say to finance things, but you
Are you guys
still be financing personally.
are you a partnership?
Yeah.
Yeah. So you would still be allowed to claim your interest on that loan,
Right.
even though you're taking it out personally as,
Right.
you know, it would still be in your better interest to finance it, even if it is a personal loan. Because when you're a sole proprietor or a partnership, your business is you. You're not,
Yeah.
business isn't a separate individual like it is for a corporation.
Yeah.
So even though you may have the loan under your two personal names rather than K and S, you're still better off to do the loan, definitely. Okay? Like a lot of people, it's like, well, I only bought this for 5,000 and that for 10 and this for 4 and that for 6, and it's like, add it up though. Your cash flow is gone. So that's one of the most common things that people do wrong is they pay cash for capital assets rather than financing them. Okay? Poor inventory turnover. This can be a toughie if you don't have enough people coming through your doors for that inventory to leave your doors. You're not generating the cash flow. This is especially tough with a new business. A lot of times you have to get people in the habit of coming to your store, which in small town Saskatchewan, you gotta get a lot of talking going. You have to find ways to market that aren't going to break you. It's tough. I'm not gonna lie. I remember starting out with one client and like literally just, where's my next meal gonna come from? But eventually, if you keep with it, hopefully it's gonna keep turning over. But like I've got one client, for example, that he does work for people that can't afford to pay him. And so instead of paying him with cash, they pay him with an old tractor that's sitting on the farm or something like that. Well, unless you sell that tractor right away and turn it into cash, it's gonna sit there as inventory. And if that tractor sits there as inventory for 4 years, you may as well have not gotten paid. So inventory turnover is huge. There is ratios, and if you see that your inventory turnover is lagging or it has slowed down from what it was previously, you wanna try to address that in your cash flow analysis, okay? Sometimes you have to gear, especially if you've got a seasonal business, like you guys are a variety store, so I'm guessing Christmas time is probably a better time for you than right now.
We don't know.
You know?
We opened in March. We haven't had a Christmas yet.
Yeah, right. So
We don't know.
I would hope that it would be, you know.
Yeah. Yeah.
So you might want to put off some of your big purchases until you have that busy season. Okay, I must have We're good. Okay, the next one's poor collection of accounts receivable. Again, if your customers aren't paying you, you don't want to keep them. There's just nothing else to say about that.
No.
Taking too high of a personal draw or wage. sometimes it's quite easy to pull out so much personal cash out of your business that you end up being the one to bankrupt your business rather than other circumstances.
That probably happens a lot, Kate.
It happens more now than what it used to, which is part of the way our generation
Well,
lives.
it's probably with corporations too, right?
Yeah, it happens with everybody more now than what it used to, because, like, say for example, my generation of parents, my mom is 89 years old, and if my dad was still around, he'd be 99. Well, they didn't go on vacation sometimes for 6 or 7 years, because if the money wasn't there, you don't take a vacation on your credit card, okay? Things have changed a little bit, and now we have a generation that it doesn't bother us too much to have consumer debt, and we go on hot holidays. We don't go just camping at the lake. We go down to Mexico or Cuba. Some of us go 4 or 5 times a year on holidays. Some of us go down and stay in Arizona for 3 or 4 months. That takes a lot of money. And sometimes you have to evaluate, like, do I want to stay in business or do I want to go to Mexico? I've seen clients that they can't keep up with their payroll deductions, they can't keep up with their PST, their GST, but every weekend they're gone biking on their Harley, going down to the States, going to this, going to that, they eat out every night. There's so many places that they could cut back. And if they don't, their cash flow is just going to keep getting worse and worse and worse. So taking too high of a draw can be a really big one. And like I say, more so now with our generation and the generation following us than the previous generation. We've had life pretty good compared to the generation before us. And it shows. Investing too much cash in investments that lack liquidity. So you want to be careful if you do have excess cash, that it's going somewhere where you can access it easily. If it's locked in for 5 years and it's non-redeemable, think about your decision, because if something goes south and you can't access that cash, it's not going to do you a lot of good. Okay? Having employees that are not making your business money. Well, this is a tough one. It happens a lot.
Sorry.
There's a lot of employees out there that are being paid way too much for what they actually produce for the business. And I've seen businesses where sales dropped $15,000, but wages went up $15,000. So it's like, okay, you're losing 30 grand. How come your employees are still there if they're not putting in? It might be time for some layoffs. It might be time to replace an unproductive employee with a better employee. It's cash flow can mean ugly decisions, and this is one of your uglier ones. Paying too much non-deductible interest and penalties to CRA or the Minister of Finance due to non-compliance. Payroll deductions, not bad. If your payroll deductions aren't that high, your penalties aren't that high. GST, same thing. If you're not collecting a lot, you only have penalties if you're owing. So if you're in a refund position, you won't be dinged if you file late. PST is just brutal for penalties. It's 10% right off the hop. If you can't afford to pay your payroll taxes or corporate tax, GST or PST, at least get the return filed. Because at least if the return is filed, you don't get charged a late filing penalty. Some people say, well, I'm waiting to pay my income tax because I can't afford to pay it anyway. You're the one that should be filing your return on time. Because if you owe, you're getting dinged a 5% penalty right off the hop. Before you even blink an eye, there's a 5% penalty. Then you get charged interest over and above. But at least if you file on time and stay compliant with the regulations, you're only getting dinged the interest. Now the unfortunate thing with CRA is and the Minister of Finance, none of that interest that you pay to them is deductible.